All right, so now you're reviewing your bank statement and you come across another transaction which reads car loan payment $193. This seems simple, but here's the real question. What actually just happened? Did you pay an expense? Did you reduce a loan? Did you potentially do both? Because if you record a debit for your car loan expense or your car expense and then credit cash for 193, then that's completely wrong. So we're going to look at how to deal with this correctly when you come across the car loan payment. So every loan payment has two components. The interest expense, this hits the income statement, and the principal repayment, this reduces the loan balance. Same cash, but two different economic meanings. This is where accounting becomes interpretation and not just recording. Interest doesn't happen when you pay. It's accumulating continuously. From the moment your last payment is made, interest starts building day by day across reporting periods. So when you make a payment, you are settling interest that has been accumulating over time, not just this month. So with loans, there are always two types of transactions. First is the payment. The cash leaves your bank account, the interest is recognized, and the principal is reduced. But the second one that's more subtle is the accrual. This is the month-end adjustment. Interest continues accumulating. So since your last payment, let's say that the payment was on the 15th, from the 16th until the end of the month, this interest continues accumulating and is an interest expense that should be attributed to that month, even when no payment is made. So you'd have a debit to your interest expense account, and you would have a credit to accrued interest, which is a liability. These are separate and both must be recorded. This is the full system. Now, to break the payment down precisely, we use an amortization schedule. And if you haven't seen the other videos in this channel on how to create an amortization schedule, I would highly recommend you go there and watch that. What this gives us is the interest per period, the principal per period, and the remaining balance per period. It's structured, it's consistent, and it's mathematical. This is your model of reality. Now here's where everything comes together. The amortization schedule tells us that the total interest for the period is $50. But that $50 doesn't belong entirely to 1 month. It spans, say, May the 15th to May the 31st, and then June the 1st to June the 15th. So we split it, $25 in May and $25 in June. It's the same total, but it's different timing. And this is the difference between knowing the number and knowing when it belongs. So at May 31st, you record the portion that belongs to May. The journal entry is a debit to interest expense for $25 and a credit to accrued interest for $25. Note that there's no cash that has been a result of this particular transaction, this adjusting entry. You've now recognized the expense has occurred, but it hasn't been paid. Now the payment happens on June the 15th. The total interest is still $50, but now we know 25 was already recorded in May and 25 is new in June up to June the 15th. The journal entry then is a little more complex. We need to debit the accrued interest for 25. We need to debit the interest expense for 25. That's the portion from the 1st until the 15th. We need to debit the loan payable for 143, and we need to credit cash for $193. This is the key moment. The payment includes previous accrued interest, new interest since month end, and a principal repayment. So here's the core idea. The amortization schedule tells you how much interest exists. Accrual accounting tells you when to recognize it. The payment doesn't create the expense, it settles it. Now here's where it gets even more interesting. The amortization schedule is a monthly model. The bank is calculating interest daily in the background. So even though your total interest is correct and your timing is correct, you may still see small differences. Those differences come from daily compounding, exact day counts, payment timing, and rounding. So your model is clean, reality is continuous. And this leads to the final step, reconciliation. We calculate using the model, we observe the actual statement, and then we adjust the difference. The model gives us structure, the bank gives us reality, and reconciliation brings the two together. So in closing, loan accounting works across 3 layers. First, interest is continuously accruing. Second, payments partially settle that accrual and reduce principal. And third, the model organizes it, but reconciliation ensures accuracy. We don't just calculate reality, we match it.